Hey guys, welcome to the Holy Macro Show. I'm Jason. I'm joined with Kashop today. Sorry about the delay, software issues. I have no idea really what happened. I just kept trying to figure it out. It kept telling me my browser was messed up, and then I just restarted the computer. It was fine. That's normally how everything goes in software. Uh, Restart, start all over again. Hey, what's up, guys? Thanks for saying hi. If you guys can hear me and everything sounds good, just give me a what's up, say hi. Let me know where you guys are from. We like to hear where you guys are from so we can talk to you guys a little bit more about your areas as well. Um, Starting out first with the first chart, we're looking at GDX. And this is something I talked about yesterday a little bit, but I wanted to also talk about it with Kashop today, which is if you look at the top of the chart, you're seeing GDXJ. That's the junior miners at the top. Up what 100 and it changes day by day, but it's over 110% at this point. They're both kind of sustaining up over 100%. That looks really good. GDX is just below that. So they're both trending. GDXJ is leading. That's something I want to see in a bull market. But right behind that, we have XME, the metals and mining sector. So the metals and mining sector is one that's what's very interesting and something that I really think is next if we're looking at this commodity cycle in the right way, which is what usually happens is we see gold, we see the gold miners start to move, then we see copper and the copper miners start to move. Copper miners are finally starting to move. XME being up 60% year to date and smashing the returns from anything else. Yeah, technology, I think, just touched 20% pretty recently year to date. Now we have XME up over 60, gold miners up over 100. This is a good time to really start looking at these commodities in the commodity cycle. So, Kashab, when you're looking at all of these sectors and you're thinking, what are you thinking when you look at all of these sectors and kind of think about, hey, everybody's still kind of overlooking gold and not really thinking about gold miners, copper, anything in the commodity sector, and everybody's still stuck on the AI trade. What does this make you think of?
So, in a way, I'm like super glad that no one else is looking because, that means I can still find some pockets of value. So, uh, I have around 28 stocks in the portfolio, and 12 of them are up over 100%. One is up for 50%. So, when you have gains like this, you're like, yeah, okay, that's great. Like, I don't really have to do anything. But then on the other side, it's like, what do I do for new subscribers? I have to find picks. And thankfully, I can still find picks. And that's the good part. As for the AI trade and why people are not coming into this sector, I honestly don't know because 2023, if you look back, it was very difficult to make money in anything other than, crypto, semiconductors, technology. Those were the sectors that really made money. If you were in gold miners, you did okay. If you were in oil, energy, anything of that sort, the year sucked. And 2024, it got a little better. 2025, it's gotten way better. And people are still stuck on yesterday's trade, the trade that worked. Not that the AI trade hasn't worked this year, but we are seeing clear signs that this is the top. I mean, you have Oracle, which is now a 900 billion market cap company, is just moving 40% in a day, which is just insane. These are the kind of moves that you see when you have a blow off top. And we kind of saw that with crypto as well last year. Now, if you look at GDX, GDXJ, it's up something like 115% this year. If you are trying to look for blow off tops, you will not find it. Maybe you will find it in one or two speculative names where, suddenly you have a big celebrity getting behind it. So we have seen this before. Warren Buffett buys Barrick and then Barrick goes up. So, we may see that kind of speculative activity, but overall, if you look across the space, if you look at all the charts, you just see charts going up and to the right. You don't see signs of a blow off top. Whereas if you look at these AI names, you see clear signs of a blow off top. And the other point of difference is gold started picking up sometime around November 2023, and it really started accelerating this year. And we have fundamental catalyst explaining why it's accelerating this year. So the dollar index is down something like 11%, and you have treasury yields rising even as the Fed is cutting rates. So, what this does is put enormous pressure on foreign investors. So, let's say you're a central banker in Poland. and you decide to hold your reserves in US Treasuries. And year to date, you're down something like 10-15% on those holdings, whereas you held gold, you're up 45%. Now, central bankers, these are pretty conservative guys, bureaucrats, they're not traders. They look at a move like this and they say, hey, the dollar is weakening, treasury yields are sinking. Where can we put our money? Well, let's put it into gold. Okay, maybe we put it into some euros and some Swiss francs and stuff, but ultimately all roads lead to gold, and that's why they are buying gold, and that's why we have this move. And then when you look at the miners, what's happening is because the gold price is going up so much, these companies are now minting cash. So you have 70-80% gross margins in mining stocks, which is insane. That's the kind of margins that you would get from Meta. So when you're seeing that kind of, uh, these companies are just printing cash, and when they are printing cash, and they're all gun shy about acquisitions because they have been burnt in the past and they had a brutal bear market. So what do they do with that cash? Well, they just return it to shareholders, or they just retain it and do buybacks. So whatever it is that they're doing, all of it is very, very bullish for the price, and all this is happening even as American investors aren't paying much attention, and they're not paying that much attention because, I mean, who cares about gold, right? It's not in the headlines. It's only now kind of starting to come into the headlines, but the big news is still, Trump is putting some tariffs on furniture and kitchen remodeling and stuff like that. Like, that's the news when the news should be gold hit 37 new highs in this year, and no one prints that news. So when you have this situation, you have this stealth bull market which is powered by fundamentals, and at the same time, you have people not paying attention mainly because no one's reporting on this. So I think that's going to change, and when that changes is when you probably get closer to a blow off top. So I still think this is a great time to enter the gold space. It's a great time if you don't already have positions. And if you do, then just ride it, enjoy these gains because you don't get these opportunities very often where you can just do nothing and you just make money. And it's actually quite hard to do nothing because every day you look at these moves and you're like, oh, is this correction going to be the top? Is that correction going to be the top? No, just let it ride, just enjoy those gains. And I know you're fond of saying follow the trend to the end until it bends, and I think we are nowhere close to the trend bending. So, what do you think?
Yeah, no, I think the same as you, which is it's like you said earlier, like it's hard when you have so many good trades at the start of the year, and your subscribers are like, I want more trades, and really it's like, look, like you could enter those same trades right now if you'd like. I wouldn't have a problem with that at all. But also looking around and kind of finding more and more trades, and granted, there are some that pop up. Not saying they don't, but trying to really find more trades is probably a bad idea here. And here's the other thing: most of the traders that we're talking to, they might have these trades in their portfolio, but they still want new trades. They want different trades, and more alpha and more this. And it's like the things that are trending, things that are really moving, usually continue to move. I mean, this is just really started to pick up steam recently. Like this was a trade. You and I have been talking about this trade for what, 2.5 years, 3 years now. So we've been talking about this trade for a long time. This trade has been moving for a long time, but it's only now really picking up steam. Yes, it was good returns. You could have some. I'm sure you had some great names in there. Me being in the ETFs were just trending nicely, 20, 30%, 40%. You're making some good returns there. But this stage that we're in now, this is that blow off top kind of stage that isn't even close to happening. That's the thing that I keep thinking about is like you said, we're not close to the end of this. But if we're in it now and it's already just starting to pick up steam, it's going to get way crazier than what it is today. Yes, 100% a year is pretty wild for the gold mining sector or any sector inside of an ETF. But at the same time, these things can really take off, and you can really start to see these explorers start to move, and that's where you're going to start to get that real alpha here. So I think this is really kind of just getting started, early innings still. I don't know how long anything goes. Once again, like that's the thing about it. That's the hardest thing to explain to people as a trader. The hardest thing, somebody said the other day, I was on a Spaces, And somebody was like, yeah, like for people who aren't like you, who, already have had these trades for a long time, and you're just kind of running these trades and just going through them, and it's real easy for you to just say like, hey, stay long. What do you tell those people? And I said, look, like the hardest thing to actually do as a trader is to stay long something that is going up. That is something that nobody wants to talk about, but it's the damn truth. It's very hard to sit in a position and let that thing run and do nothing and sit on your hands. And very few like analysts will get on here or on YouTube or on their newsletter and say anything like that, because you don't get new subscribers by telling people to do nothing. However, you make a lot of money by telling people to do nothing, because right now is a great time to do nothing and just kind of ride these trends. There's new trades that are coming. We've had a few alerts recently, but we're looking at different sectors. But in the gold mining sector, it's like, I don't really know what to do besides let these things run. I know you found a couple great ones, some gems. That's really your wheelhouse more than mine. But for me, I'm just like, I'm long silver, I'm long platinum, I'm long palladium, I'm long gold, I'm long gold miners, I'm long, like there's a big list there, and it's a very diversified list, and I just want to kind of let that run at the moment. So we did get a bunch of questions who came in as we were talking. So Steve said, how do we know when we are in the last move? Do we have to see a parabolic move in the miners? You could go first, Kashaf. Speak about it
Sure.
from a fundamental angle, and I'll speak about it from more of a technical angle.
Sure. So the it's very hard to quantify what the last move is. So usually the way I exit a sector is when I see, the potential in this sector is maybe, 10-20% more, and there is some other sector which is so beaten down that it has 100-200% upside kind of situation. So what I do is then I rotate. And the example for that, which I did recently, is last year. It was around Feb to March 2024. I saw the price action in Bitcoin, I saw the price action in gold, and I said, there is not enough upside in Bitcoin to keep me here. I'm going to sell it and move to gold. So that's typically what I do when I exit, because if we are trying to guess, is this the blow off top? Is this the blow off top? Every single day, you're going to drive yourself crazy. And you're going to get to a point where, okay, so the stock trades at 40 times earnings, but because the commodity price is going up, next year it's going to be trading at 35 times earnings. So you can keep doing this analysis, and all that will lead to is analysis paralysis. So I don't do that. I look at multiple sectors, and when it seems right for me to switch from, say, gold miners to Canadian energy producer, let's say, so then I will make that switch. So then I'll lower my allocation to the gold space and move it to the other space. And eventually, sometimes I'll be early, sometimes I'll be late, but broadly, I will play the rotation right. And that's how I end up exiting, because otherwise, just looking at the daily price action and trying to guess at this, especially when you have these crazy momentum moves, it will just drive you nuts. So I don't like to do that.
Yeah, I think there's, there's one, it's when we're looking at a trend, we have to think of so many things. One is, and this is the most important thing, I don't know shit. That's the number one thing you have to keep in your head at all times, which is you don't know a damn thing. Not saying like we can't speculate, we can't come up with probabilities, we can't understand what type of cycle we're in. Looking at this next chart that I brought up, we're looking at the allocation from funds to gold at the moment. That's still really low. So we can look at these things and say, okay, well, institutional buying is very low. The next chart I think I brought is the shares outstanding is really low. The short interest is very high. Let me actually pull this off so people can see that chart. But the short interest is really high as well. So shares outstanding low, short interest really high. So we can look at all this and go, okay, there's probably more legs for this rally to continue to move higher. And then also parabolic. So let's just use that phrase. I hate the term parabolic. And it's not because it doesn't exist. It's because if I take a chart of gold and I look at it on a monthly, it looks like a trend is really steady, stable, and just beginning. If I take a chart of gold and I look at a daily chart, it might be a little bit more extended. But if I look at an hourly, like you're starting to get to that point where you're like everything looks parabolic if it's moving. So, parabolic doesn't mean the end of a trend, very similar to if you're looking at RSI and you're looking at something getting overbought. I think Sam highlighted that gold had its most overbought reading in, since going back to, I want to say it's like the 70s. So does that mean that the trend is ending? No. In the 70s, when that happened, it continued for a whole nother year and then had another move after that. Now, does it mean the trend is ending? Absolutely not. It's the same thing. It's the trend just beginning. Most of the time, overbought is actually a good signal that a trend is beginning. And to the next question, which actually goes into this, great questions, guys. Keep bringing them in. Where was that? Gold miners because of pullback. Okay. This was another one. Even though we we're expecting gold to go much higher and also gold miners because of that, is it better to wait for a little pullback in these stocks or invest right now itself? So here's the hard part. One is everybody wants to know what's next. And so a lot of the research, a lot of the things, we're going to talk about is going to be what's next because people want to know that. Here's the hard answer. When you're trading in a long-term time frame, like let's say 3 months to a year, when you're trading on that sort of a time frame, you really want to hang on to those winners and just let them run. It's the hardest thing to do. We talked about it earlier. It's one of those things that people think is easy, but it's very, very hard. It's the hardest thing to do. And so, like, if you're waiting on entry, here's the hardest thing to think about. Is it going to make you feel better to wait for a pullback? Or is it going to be more profitable to wait for a pullback? And that's kind of how I always think of breakouts or buying things as they're high and trying to sell them higher as a trend trader. Is I want to really take those trades no matter what. They don't feel good. There's nothing that inside of me that when I see a 52-week high or 100-day high or a Bollinger Band breakout that goes, man, I love buying this right now. And actually, my brain tells me the opposite. It tells me this sucks. Don't do this. Something is wrong. However, that's how the best trades really happen, is taking those trades with momentum. As Kashop said, the sector has a lot of momentum in it. You're probably not going to catch many trades that you're going to get a great mean reversion setup in. Sure, you could wait for some pullback. You could, wait for the dollar to get strong. You could try to buy it like that. I'm just saying it's going to be really hard to do. If you don't have a position, the best way to do it is find those new zones where you would buy things. A new all-time high, new 52-week high, breaking above a moving average. However you do it, I'm not saying there's a perfect way to do this. And if you're trying to buy those trends, then that's the way you're going to make a lot of money here. That's the idea. But if you're more comfortable on those pullback trades, trade the pullbacks. And that's another thing a lot of people aren't going to say to you, which is try to do what works for you. For me, like, I've learned that buying high, selling higher makes sense. It's not because I like to do it. It's because I know that it makes a lot more money. I know back testing it works. And in my time frame, it works very well. But for other people, they might be trading on, they might be in and out of these trades all the time. Pullback's fine in that type of scenario. But in gold mining stocks, energy stocks, copper stocks, I really suggest trying to look more into breakout strategies and technology. Here's a great example. And I brought this up before, but I'll bring it up again for anybody who hasn't heard it. If you take a simple system, this is a system that actually works. It actually makes money. Has positive expectancy even. You basically buy the S&P 500 or E-mini futures when the S&P 500 has 4 days down. So 4 days down. Then you buy the S&P 500 after that fourth day. So on the fifth day, you buy it. I think it's like 78%. It's pretty high win rate. 78% of the time, you're going to make money. You can put a stop right below that fourth day low. So most of the time, you're going to make some money on that trade. Do that same trade in oil. That's the beginning of a trend. You're actually going to get killed. That has I think the win rate when I posted it last was like 22%. You just get killed over and over again because most of the time commodities, when they're starting to mean revert, they continue lower. There's a lot less news. There's not as many people buying it to really put those lows in as quickly. So you see those things trend one way and the other very quickly. So that's why I say, like, if you're gonna trade the commodity-based markets, gold miners, energy, copper miners, buy the breakouts. I think that's a way to do it. And so one more here. How do you approach finding opportunities in other metals or materials? There seems to be an ongoing scramble in multiple supply chains after export bans last year. So how do we find new opportunities in other metals, minerals, different areas of the commodities market? I'm sure this even covers energy and so on. So you can start out, Kashap.
Sure. So I just had one last point to add to Paras's question, which is
Mm-hmm.
one is waiting for the pullback, and if it doesn't come, then you're miserable because you're missing out. The other is you don't even need a pullback. So if you look at what happened to gold from April to August, it just went sideways. Now, if you're buying in and then you have sideways price action for a few months, are you going to say, "Hey, this trend is over. This is stupid. I'm going to exit now and get my capital out because this is done. I'm moving on to something else." Or are you going to be riding that consolidation, or are you going to be adding to that consolidation? So it's important to have that strategy in beforehand because markets don't just trend and mean revert. They also go sideways, and sometimes they go sideways within a trend for a very, very long time because they're digesting the previous move. So in that situation, you really have to ask yourself, what kind of trader are you? And that's the way to approach it. And moving to the next question, how do you approach finding opportunities? So, I mean, I do this day to day. I do this for a living, so it's easier for me. But uh, if that's not you, then I think the best way to do it is to follow multiple sources on FinTwit, multiple sources on podcasts. Look for like say subscribe to a mining newsletter where they talk about everything. So something like Globe and Mail in Canada. So if you do that, then you kind of start to be aware of more opportunities, and that way you can start to see what's trending and get in ahead of the crowd.
Yeah, that's good advice. I think it's also the simple fact, if you're trading and you're going, okay, well, I need to understand what's going on in all these different sectors. One is use the ETFs, not as in trading. It doesn't have to be your trading vehicle, but just understanding, hey, if XLE is moving up, most of these sectors inside of energy or most of these stocks inside of energy is moving up. This way, you don't have to pay attention to 5,000 different stocks. You can basically pay attention to the sectors, and then from there, get into what's going on underneath the surface, figure out the stocks inside of those ETFs, and kind of go from there. I also like the idea of making lists. Making a watch list is so important. Every single good trader has a watch list. I know Kashap does. I do. Just about everybody I know has a watch list of stocks or positions they watch. For me, sticking to the macro space, it's really sector based. So this is the reason why I'm always able to kind of tell you guys about the opportunities that are going on. Hey, copper is starting to move. Hey, copper miners are moving. That's because I'm always paying attention to these big ETF sectors. I'm not going through the individual stocks going, okay, well, this one stock is moving great inside of this sector that I really don't know much about. I don't think that helps you. I think what really helps you as a trader is thinking of, if copper miners are moving globally, like the global copper miners ETF, COPEX, then I think, okay, well, all of these copper miners inside of it should start to look pretty good. And you can find your buy signals within that. So there's a bunch of different ways to do it, but mainly is, to have a wide net, it's build a wide net. Build all those different sectors, all those different positions. Maybe there's like 5 or 10 bellwethers that you want. We always have we have a bunch of scans. We're always kind of highlighting these different sectors, different opportunities, different things that are moving at different times. For me, once a week, I think it's really important to really see like what's leading on a 3-month and year-to-date basis. So, FinViz is a good one for this. Very easy. Koifin.com is another good one for this. So you guys can go to that, either one of those websites, look at performance metrics, look at the currencies, look at the sectors, look at all these different things, and get an answer on what's moving at what time. And same with Koifin. I think free Koifin even offers a lot of that stuff as well. So, there's a couple ideas there, and then we'll continue on. So what's the next chart? That's the other thing I meant to ask myself because I didn't even click through them yet. We got on a little late. Oh, silver to gold ratio. Nice. So silver to gold ratio. And feel free to keep asking questions, guys. We'll try to get to them as soon as we can. So silver to gold ratio. Silver has been a monster. I mean, even yesterday it was really interesting. Gold was down, silver was up, I think maybe 1.5%, something like that. So it's just been this monster that's continued. And it's the one we kept, talking about. Are we going to see this thing move? And when this thing actually moves, how far can it actually go? Is it going to be like the last cycles? Most people thought no. Now we're up here nearing $50. Like we're getting closer. We're not there yet, but we're getting closer. I think it was over. I'm looking at the futures for me. The futures are at 46 today. I don't know what the spot prices are at right now, but I'm pretty sure, like I keep saying, like we're gonna hit 50 by year end. I wouldn't be surprised if we get above that by year end. Now we're all the way up here. I'm definitely thinking it's chip shot away. The price is probably going to basically be magnetized to that level. So, what are you thinking about silver here, Kashab? Do you think it's something that's going to continue to lead the way, or do you think it'll start to slow down and the miners will be the ones who lead the way?
So I think silver is just getting started. And if you recall, I have not always been the biggest silver bull. And the reason for that is because gold starts the journey. And once gold picks up momentum is when capital really comes into the space. And when capital comes into the space, that's when you see big moves in palladium, platinum, rhodium, silver, and on, like all the way to the small cap exploration stocks. So you find moves in silver focused mining companies, silver focused exploration companies. So all of that starts a little later. And the move in gold really started late in 2023. So this is kind of the time when you will start to see silver pick up. So you already saw gold pick up, do very well. Then you saw the big moves in platinum and palladium, and then you have Sibanye Stillwater for that. So you saw those big moves and those names, and now we are finally starting to see the big move in silver. So asking whether silver will move a lot now is like asking whether gold would have moved a lot in 2024. So yes, of course it will. But had you asked this question 2 years ago, my answer would have been different because we were in a different part of the gold cycle. So this is the part of the cycle where you can really press on silver, the silver related mining companies, the silver related exploration companies. And the reason for that is if you look at your Newmont and your Agnicos and all these companies, right, the market cap is already pretty high. So a new person coming into the space, are they going to be buying gold, the gold stocks at these levels, or are they going to be like, hey, where can I find alpha to this move in something that hasn't moved that much yet? And so some part of the capital rotates from the large cap gold stocks and from gold itself to silver. So that's why you're seeing the silver to gold ratio, kind of shrink, meaning silver is starting to outperform gold. So once you start to see these moves happen, then it becomes broad based, and then you have a awesome rally in everything. And it'll probably be over when you find advertisements for copper rounds. Like that's what we saw in the previous bull market. Like forget about gold, silver, you find copper rounds getting sold. So until we reach that point, I think we are going to have a tremendous bull market in silver, the silver related mining stocks. And if you're buying the mining stocks, then you really have to be careful. There's jurisdiction risk, there's execution risk, and there's all sorts of promoters selling you on concept stories, which don't really work. So it's a niche space. And because silver is even more niche than gold, you need to do a lot more research. So hopefully by the time this move picks up, you're going to see a lot more silver ETFs, actively managed ETFs. Like now you have the gold bug ETF for the gold miners launched by Sprott. You're probably going to find similar products getting launched. And that's when we'll know that we are kind of entering the mature phase of this market. So right now we are still in the very early stage.
No, I agree. I think we're in the early stages here, and we continue to see more and more signs that it is early and it is just starting to move. This chart might look like silver looks pretty extended, but I'm sure a lot of you have seen the long-term silver chart that I've posted a bunch of times. It's a cup and handle going all the way back to the 70s. So we're seeing, a 50-year breakout possibly start to happen anytime now. So when it gets over $50, that's really going to say like, hey, I think silver hit about about $50 back in the 70s. Silver hit about $50. That was 2011. So now today we're about to hit $50 again. We get above that zone, we have a massive breakout that we've never seen before in silver. So who knows how high it can go after that. So I think that's going to be an interesting thing to keep paying attention to. Speaking of interesting things to keep paying attention to, global bond yields continue to move higher, and everybody continues to think that this cannot happen in the United States. And it reminds me of something, Kashop, which is when you look back at COVID, when that happened, everybody said the same thing, which was, well, they'll never shut down the economy in the United States. I mean, they did it in China, but that's China. It's communism. Of course they would do that. And so it's probably the same thing people are thinking now when you look at this chart and you go, well, that's the UK. They have these issues that I don't agree with, so therefore like that's why this is happening. And then they look at, Japan, it's like, oh, money printing, negative yields, all this debt. Of course Japan's yields look like that. But really, like, these are all connected. Like, this will, somebody was trying to tell me the other day that nothing, like, Japan will not affect the United States. And I was like, it's one of our biggest trading partners anymore. It's like one of our, like, I don't understand what like monetarily especially. So what are we talking about here that this wouldn't affect the United States? Same with the UK, same with Europe, same with Germany. So all these yields just kind of continue to move higher. Germany's near the highs. It broke out. UK broke out. Canada, it hasn't quite broken out yet, and the United States, our yields bottomed and started to move higher, and even the 2-year, all the way down to the 2-year, they all started moving higher the second the Fed cut rates. So, what are we really looking at here? Is the bond market trying to tell us inflation is here to stay, or are we completely wrong on this situation and we should be buying bonds and retiring in 50 years off of our bond trade?
So you and I have been talking about how all this money printing is going to lead to stagflation, and we have been talking about it ever since the COVID money printing. The Fed printed something like $4 trillion in 40 days, which is massive amount of money. So we have been talking about it ever since, and 2022 was kind of a reprieve from the stagflation. So you sort of started to see the economy try to heal itself, and the Fed raised rates, a little too late, but they tried to do something and then they quickly reversed it once the banks started falling apart. So if you go back to the 1970s, like everyone goes back to the 1970s and say, hey, look, silver moved, gold moved, you had stagflation, and all of that is true. But even in the 70s, there was this period from 1974 to 76 where everything kind of looked like things would return to normal, that stagflation wouldn't continue. And then it reversed. And once it reversed, that's when you had the crazy moves in gold, lumber, pretty much everything, all the way to 1979. So I think 2022 was kind of that period, like the 1974, 76 period. And now we are, full throttle on the way to stagflation. And that's what you're seeing in the bond yield. So I wouldn't buy these bonds. I wouldn't touch these bonds. I wouldn't even short these bonds because you never know what the central bankers are going to do. So, today, tomorrow, Japan might wake up and say that we are going to do more yield curve control. We don't care if the yen goes to 200. It's important to save the bond market. Or, the Fed might come up and say that, we are under too much pressure and we have to start doing QE again and we're going to target only long bonds this time. So, you never know what could happen or like what's happening already in the US Treasury market. So the US Treasury is issuing debt and using that money to repurchase old debt. And they are doing this so that the yield curve sort of stabilizes. So you see all these manipulations, these central bank price action, all of this in the bond market, you just want to avoid it. And there is nothing to be gained by trading this. So even let's say inflation goes to 3% and the 2% target gets revised to 3% target. What are you really going to achieve by buying government bonds and getting 3% in 30 years? Absolutely nothing. And most of that is going to be taken by taxes and, little higher inflation in one or the other year. So you get nothing. So you may as well just put that allocation into gold. And interestingly enough, Morgan Stanley is kind of come around to that view as well. So from the 60-40 portfolio that they used to recommend, they're now saying let's do 60-20-20. So cut half the bond allocation and give it to gold. And I think that's really the smartest thing to do. So, they're kind of late to the gold trade, but even then, it's like good to see that they're also waking up to it. And once they start doing it, then it becomes consensus. So it's similar to how when BlackRock got into the Bitcoin ETF space, everyone's like, hey, okay, Bitcoin's not speculative, it's not for drug dealers, it's not for the Silk Road guys, it's for everyone. And then they started buying in and then they drove it up. So I think we are going to see a lot of the allocators say, yeah, gold doesn't just need, and you showed the chart where they have a 2.4% allocation to gold, so maybe that goes up to 20%. And once you see that kind of move happen, you're going to see bonds take an even bigger hit. And it's going to be worse because the currencies are also going to take those hits. So then you have the double whammy of your currency dropping in value and your bond yields soaring. So you lose on both ends. So in that situation, you're going to see gold really take off. And I wouldn't be surprised if 10 years from now, people are measuring all their gains in gold terms. And this is something that gold bugs have been talking about for a while, but it's not happened because the dollar's always been stable. But now you never know, because if everyone wakes up to it and it kind of becomes consensus, then it may very well happen. So instead of benchmarking to the S&P 500, active managers can get benchmarked to gold. So I think all these points, all these the entirety of evidence that's piling up now just says avoid bonds, and whatever you want to allocate to bonds, just move it to gold.
Yeah, so no, great point. Um, I think that that's so significant, which is the fact that countries continue to move, like Poland, they were buying more gold than China recently. I don't know if you saw that. So Poland buying more gold than China recently. So we're seeing all these countries get very interested in gold over bonds. And we're seeing the allocations for bonds for these countries moving lower and gold moving higher. This is something we haven't seen in many years. I want to say this hasn't happened since what, the 90s, maybe 80s. Like it's been a long time since we've seen this type of move. And that's going to put a lot of pressure because there's so much demand for treasuries these days. When you're money printing and you're putting all of these bonds out on the market and you're doing QE and you're lowering rates, like somebody's got to buy these things. And there's so many out there at this point that we're just not seeing that there's the demand for them anymore. There's more demand for gold at the moment. So, I want to stay on the side of that trade. And I also think that it's also these countries aren't stupid. Like they know that they're creating inflation. Like the central banks know they're creating inflation. The countries know that inflation is happening. The big traders also see that as well. So like that's basically takes care of all the money in the bond market. The bond market is the biggest market in the world. A lot of people talk about market manipulation or this or that. The bond market is so big that nobody's really manipulating it. But what people are doing is following what's going on. Like, hey, oh, the Fed's going to lower rates. We have countries that are all easing in one form or another. What's going to happen from that? Well, the countries and the big traders all know that that's going to lead to more inflation. Myself personally, I believe the same thing. And I think it's just showing up in the bond yields at the moment. I mean, we continue to kind of see a bunch of these moves kind of setting up. And a couple charts I brought that I just want to ping off of you real quickly, and then we'll get to the last ones, which is the correlation between the US dollar and the US 10-year yield. So when we're looking at the US dollar, US 10-year yield, everybody goes, these things have to move together. And it's the same thing here. The commodity index, which is mainly energy, oil and the dollar is moving together now, and that's going to stay the correlation forever. I updated this chart when the correlation was at an all-time high over here. It rolled over quite recently after that. I want to just bring this up real fast to just say, hey, that correlation isn't going to stay. I know a lot of people were like, oh yeah, the dollar, and because the United States is producing so much oil, that we're going to get into a situation where the dollar and like we're going to become a commodity currency. And because we're the we're the world's reserve currency, that's most likely not going to happen. And so, that correlation was there for a little bit, but it rolled over. And even if you look at it, when oil started to make its big move, you had that correlation pretty low. And then basically it took off when you had the Russia-Ukraine crisis. And the reason why, and I always talk about this, I call the dollar the panic currency. I don't think it has value in the ways a lot of people do. I think our Defense Department gives it a lot of value, and I think that's the main reason why it does. And also, people go to it in times of stress. So we saw that stress happen, the Russia-Ukraine war. People ran into those things together. Correlation kind of hung around for a little bit after that, but it's rolling over. So I just wanted to say that correlation is changing. I would look for more dollar downside, more commodity upside going forward. You guys have got this chart a million times, just basically showing you that we're going to start trending up in the yield curve, and that's usually a bull steepening is what that's called, and that's usually very positive for commodities as well. And you guys got this one yesterday, but that's one of the longest band squeeze I've ever seen in anything ever. It's a monthly chart. Huge band squeeze, ready to break out to the upside. If this thing breaks out, like it's over. Like commodity super cycle is here, and get ready. So we've already seen most of these commodities move. People keep kind of pushing back at me and go, well, not all the commodities are moving. The commodity index doesn't look great because it's mainly energy based. Lithium miners are moving. Rare earths are moving. Precious metals across the board are all moving. Industrial metals are now starting to move. Copper, steel miners, and so on. And we're seeing the underlying stocks catching bids as well. So, just keep this one on your radar. You start to see CRB start to really break out, or oil start to get above 80. Like, I think this thing's going to take off, and I don't think it's going to be slow. I think it's going to be very quick. So energy sector, just a level to look out for, 101. That's that big buy signal target. If we get above that level, that's basically a breakout going all the way back to 2008. We hit a new high in 2014, and we've just kind of chopped around ever since. That's going to be a big signal for the energy sector. And then coal stocks. Coal stocks here, I think it's an interesting one because nobody's really paying any attention to these. What was interesting, Kashop, and you'll find this funny, I went onto my watch list for coal stocks it was probably a month or two ago. Half of them were delisted. Like half of them were delisted. There's no more coal stocks anymore, and at that point is usually when you start to see these move. I started to get signals for these starting to move pretty recently. So once again, like all of these areas are moving. And, we don't have enough. People keep talking about uranium, and uranium trade's great. We're long uranium as well. But also, we can't bring on facilities as quickly as people think. So, there's a lot of regulations. It takes a long time to build these facilities. Like, it's going to take probably 5 to 10 years to even really put a dent in it. So, we're still going to be using a lot more coal, a lot more oil, a lot more natural gas. Like, we're still going to be using all of these resources going forward. So, Kashop, we wanted to give you guys, we have a bunch of trades, and Kashop has even more individual stock trades than I do in certain areas in the market. And so one of them that we were looking at that was just something that we wanted to toss out to you guys, we keep talking about the next moves. And gold, silver, they've moved. Copper miners really, to me, are the ones that are really moving. So Southern Copper was an interesting one. If you're on YouTube and you go to the description, you can actually click on a link where I highlighted Southern Copper and a bunch of these going back to maybe 3 or 4 months ago. I can't remember. But Kashop, I want to ask you about it because, the internals of the company, what's going on here? Do you think this thing still has legs?
I think it has a lot of legs. So The interesting thing in this, so I have watched list going back several years, and I have pretty good memory. So when I first started following the copper miners, Freeport had a higher market cap than Southern Copper, and then Copper kind of started to catch up. And now, if you look at it, it's almost double the market cap of Freeport, even though Freeport has higher production. So what's going on? You could say that it's kind of a run to quality, or the market is inefficient. You can come up with all sorts of explanations, but what's happening here right now is that Freeport had a little bit of a disaster in Indonesia, and Southern Copper doesn't have exposure to that part of the world. So it's mostly Mexico and Peru and South America. So investors are bidding up Southern Copper because it doesn't have those issues. And copper price is going up, and you don't have any production issues, so you're printing money. And really, like, if you're a copper investor and you're not buying Copex and you're looking for large caps to get into, what do you get into? Do you want to get into a miner which has some kind of trouble, or do you want to get into a miner which looks neat, the chart looks clean, and it has a great story as well? So investors are buying Southern Copper, and maybe it's time to switch out of some of the other copper names into Southern Copper if you're looking for that large cap exposure. So this is something I just bring up. It's not something that I own. It's something that conservative investors can look at.
Yes, exactly. So, we'll come on this show, and maybe once a week we're gonna not give you guys all our best picks. Those are for our subscribers, but maybe coming on and giving you guys some large cap names you guys can start thinking about in areas that we're both looking at. Because really, to me, it goes back to the Jesse Livermore idea, which is being very bullish in a bull market, being bearish in a bear market. And most of the time when the whole stock market's moving up or a whole sector is moving up, most of the things inside of it move up. So, owning some of these large cap names, if you're a more conservative investor, want something that's just going to make you some money steadily. Not to mention, they're still commodity stocks. So it's not going to be like, hey, I bought the S&P 500. I'm going to make 20%, 10 to 20% this year. It's going to be more like, hey, you can still make 50 to 100. I mean, the sectors are over 50% this year, and most of these commodity based sectors. So I do think that we'll keep coming on. We'll keep throwing ideas out like this. And if you guys like that, let us know. And definitely check out the description. It has a bunch of picks in there aside as well. All right, guys, we got to run. Shop, thank you for joining me. This was a lot of fun. Nick also mentioned FCX Biggest Mine had a slide. Yep, we did hear about that pretty recently. SCCO is a better company. We do like it. And Kashop probably likes it for certain reasons that are more fundamental than me, because he's talked to me about that before too. I like it because it's showing more relative strength than the rest of the sector, and it has been this whole time. So, all right, guys, you guys take it easy. We'll see you guys next week at 10 a.m.
Thanks, Jason. Bye, everyone.